As a kid, I never really understood how all the gears to an economy could just stop working so fast. It never really made any sense. There was people that were willing to work, there was consumers that would have been able to buy, and the industry and resources were still there, but the economy still stopped, and it never made any sense. So I'm going to be going over exactly why markets collapse. What is going on, you guys? My name is Daniel, and welcome back to Money Recall. So I'm going to try and make this as fast as possible and as straight to the point. But to understand the point, I'm going to have to cover a little bit of other material. So what exactly creates a recession, depression, and pullback of the markets? So there's this concept within modern banking called having an elastic money supply. So what this means is they are able to increase the money supply or shrink the money supply. In theory, this is to meet the demands of expanding markets. This, in theory, would allow markets to expand and continue expanding without being bridled by the restraints of hard currency, so silver and gold, that the original dollar was backed by. So this is anything but true, but this is how they portray it to peddle it to the public, so the public will find it palpable. This system relies heavily upon book entries, paper money, and the modern day equivalent of book entries, your digital currency. So not cryptocurrencies, but the digital inputs that are now in the bank that zip around the world at super fast rates. So how is this achieved? By the magical banking tool of fractional reserve lending. So back in the day, this meant that banks, when the dollar was actually backed by gold and silver, had to have a certain amount of gold and silver on hand in the bank to have so many notes out in the public, or paper dollars. So these dollars enter the system in the form of loans and are cooked up with a technique known as bookkeeping entries. At its very, very base, this is how it works. So a man walks into a bank and gives them $10. As soon as he does that, they put a line entry, $10 to said man. A woman then walks into the bank and says, I want $9. And the bank then goes, you're approved. Here's your $9, and writes that she owes $9. So now there's $19 that are owed to people in general. The woman goes and buys products and services from whoever it is that they do it. She gives them the $9. That person then deposits $9 into their bank, so there's $19. And this continues with somebody going in and requesting $8 and all the way down until that original $10 create $100. And so what is going on is that is expanding the money supply as that occurs and goes down the chain. This process is known as fractional reserve banking, and it allows the money supply to grow. So the way to constrict the money supply is to reduce the amount of credit and loans available to the public. Then there will be less money in the form of loans, which is how all our money is created these days. And by restricting the credit amount and loans made, they're restricting the amount of available currency in the market. What this will do is it will flush out bad investments and risky loans. This is technically a good thing because it allows for the renewal of the economy and a blank slate again. It affects everyone when these shrinkages of the money supply occur, because even everyday average people who have loans are now finding it harder to get their hands on money, as there is less and less of it inside the marketplace. And the sadistic part of this is, as these banks loan out this money that actually never existed and the banks never had, they get to collect interest from you in the form of actual money and actual profits on money that they never had and never existed in the first place. The elasticity of the market is controlled by constricting the credit and loans available to the public. In other words, shrinking the money supply. This is usually done in an effort to stall inflation and return an overheated market back to normal levels. This constriction of money is what causes recessions, downturns, and overall economic hardship for everyone involved. So if you were to take a bell curve, and the average economic recession under normal statistic investigation would be to have most of them around the center of hardship and not really that big in their actual boom and bust cycle. However, analysts have discovered that the majority of the booms and busts on this bell curve occur on these areas rather than their statistical norm inside the bell curve. This is due to the fractional reserve lending of the banks. Without fractional reserve lending, there would be a continuous upward movement of the markets. However, there wouldn't be these huge booms and busts that we see in modern day society. These economic contractions can also be triggered by a rapid default in loans, which creates a lot of money that no longer exists. A constriction of the money supply can also occur when large loans go bad, or collections of loans, like what happened in 2008. So if this helped you out in understanding why the boom and bust cycle is so prevalent in our modern day society and why it occurs, throw a like and subscribe. And as always, have a great day.